Hi all, I'm Ian Brealey. Today we're going to do a quick sprint on double entry bookkeeping. Have you got your coffee? Might need that a little later. So here we go. The financial transactions of a business. Business is men, money and machines at work, and you can see that just walking up and down the street, generating the financial transactions. And these are recorded with the aid of double entry bookkeeping. What are the key benefits of double entry bookkeeping? It prevents errors because debits must always equal credits. A quick balance check, a trial balance, will immediately flag arithmetic mistakes. And accurate reporting. It provides a crystal clear real-time snapshot of a company's financial health, profit margins and overall net worth. And it's required by law. Most commercial companies and tax authorities require double entry records to generate official financial statements like balance sheets and income statements, and also from those records we make quarterly returns. Double entry bookkeeping is an accounting system where every financial transaction recorded affects at least two different accounts in equal and opposite ways. For every debit entry made into one account, a corresponding credit entry must be made to another, ensuring that the foundational accounting equation always stays perfectly balanced. So this financial accounting equation, the entire double entry system is built on a single unbreakable mathematical formula, and that is assets equals liabilities plus equity. And you'll recognize the balance sheet there. So assets, what the business owns, so cash, inventory, equipment. Liabilities, what the business owes to outsiders, so bank loans, supplier invoices. And equity, the owner's residual stake in the business after subtracting liabilities from assets. We'll need a sip because now we're going to go into understanding debits and credits. Debits, DR, and credits, CR, do not mean plus or minus. Instead, they simply refer to the side of the accounting ledger where the transaction is tracked. Debits are always recorded on the left side of an account ledger, while credits are always recorded on the right side. How they affect an account depends entirely on the account type. So for assets are increased by a debit, they're decreased by a credit. And the normal balance of an asset is a debit. Expenses, the normal balance is a debit. Liabilities, the normal balance is a credit. And equity, the normal balance is a credit. And revenue, the normal balance is a credit. Now we'll chat a bit about cash accounting. Simpler businesses which are not registered for VAT tend to follow cash accounting. Double entry cash accounting records transactions using the two-sided direct debit and credit system, but only when payments and receipts go through the bank account. As the business grows, double entry usually follows accrual accounting, so tracking money when it's earned or owed. Combining double entry with cash accounting means you ignore unpaid purchase and sales invoices until they are paid. Accrual accounting takes account of these accounts receivable and accounts payable. Your transactions are greatly simplified. No accounts receivable is recorded. You do not record a sale when you dispatch goods and send an invoice. You record it only when the customer's cash hits your bank account. And these days, with online banking and downloading a spreadsheet from the bank, that gets you an awful long way. No accounts payable are recorded. You do not record an expense when a utility bill arrives. You record it only when you actually pay the bill. Do you still keep a file of unpaid sales and purchase invoices? You bet you do. In short, in the simple case of cash basis accounting, the transactions simply reflect the entries on a bank statement. This is usually recorded in a manual or digital cash book. And as I've said, accounting software takes this a step further by connecting to the bank account, allowing you to categorize transactions nowadays with the assistance of AI, which predicts the category based on previous experience. This can enable you to categorize hundreds of transactions at a time, allowing you simply to review the transactions and approve them through the software, which is very valuable. Common transaction examples. We won't go into too much depth, but it's helpful to consider common transaction types. Receiving a payment from a customer for goods or services rendered. We debit the bank. Assets increase and it's on the left side. And we credit the revenue account. Revenue increases on the right side of the ledger account. Now paying a supplier for goods or services rendered. The debit this time is the expense. Expenses increase, and that's on the left side. The credit goes to the bank account. The asset decreases, and that's the right side of the ledger account. So expenses increase and assets decrease simultaneously. Now we'll talk about accrual accounting. So now we reflect those files of unpaid sales and purchase invoices in the accounting system, which as the business grows is an efficient and convenient way of managing those receipts and payments and making sure you get paid and that you pay your suppliers. So invoicing a client for goods or services rendered, the debit is going to go to, this time, is going to go to accounts receivable. The asset increases, and that's on the left side. The credit is going to revenue. So revenue increases, the right side of the account. The result is assets and revenue increase simultaneously. Receiving an invoice from a supplier for goods or services rendered. The debit goes to purchases. Purchases increase. That's on the left side. The credit goes this time to the balance sheet account, accounts payable. So the liability increases, so that's the right side of the account. So expenses and liabilities increase simultaneously. Now we receive a payment from a customer for goods or services rendered. We debit the bank. Assets increase, so that's on the left side. And we credit the accounts receivable. In this case, assets decrease, That's the right side of the account. So as a result, assets increase and liabilities decrease. Then receiving payment from a customer for goods or services rendered. So we debit the bank, and that's on the left side. We credit the accounts receivable. The asset of accounts receivable decreases. So that's the right side of the account. Now we'll talk about the trial balance. A trial balance is an internal accounting report that lists all general ledger account balances to verify that total debits equal total credits. It features account names, a debit column and a credit column. So key components and structure: there's an accounts list, a chart of accounts, which shows all active general ledger accounts, assets, liabilities, equity, revenue, and expenses. The debit column on the left holds accounts with debit balances, including assets and expenses. The credit column on the right holds accounts with credit balances, including liabilities, equity, and revenue. The sum of all the debits must match the sum of all the credits. You can't have a one-sided recording of an item. The types of trial balance: an unadjusted trial balance lists the raw data. An adjusted trial balance is the trial balance which has been updated, recording accruals, prepayments, the taxation liability, and so on, all the year-end accounting adjustments the accountants do. Once we're happy with our final trial balance, we have everything we need to provide a balance sheet and profit and loss account and calculate that tax liability. We probably need a sip at this stage. The profit and loss account. A profit and loss account, also known as a profit and loss statement or income statement, is a financial report that summarizes the business's revenues, costs, and expenses over a specific window of time, usually a year. It tracks the financial performance of the business to show whether it generated a net profit or incurred a net loss. A standard multi-step profit and loss account uses a logical top-down sequence to show how money travels through the operation. Revenue is the total money earned from primary sales before any deductions. The cost of goods sold is the direct costs of producing or buying products and services. The gross profit shows the financial efficiency of production, calculated as revenue minus the costs of goods sold. Operating expenses are the general administrative and day-to-day overhead costs, and direct labour would tend to go in assessing gross profit. Indirect labour, such as salaries, administration, would go into assessing the overheads and the net profit. The net profit is often referred to as the bottom line, the final earnings remaining after subtracting all possible expenses. And from this statement, you can calculate key ratios, which are important in the management of the business: the gross profit margin, the operating profit margin, and the net profit margin. So now we come on to the balance sheet. And in fact, the profit and loss account shows the position as we move from balance sheet to balance sheet over time. So a balance sheet is a financial statement that provides a snapshot of a business's financial position at a specific point in time. It reveals what the company owns, what it owes, and the amount invested by shareholders. Over time, a business moves from a balance sheet to balance sheet. To master the core accounting equation, assets equals liabilities and equity. Assets are what the business owns or controls to generate future income. Liabilities are what the business owes to external parties or creditors. And equity is the remaining value belonging to the owners after paying all debts. And again, we can calculate sort of financial health metrics, current ratio, debt to equity ratio, and working capital, and compare those over time. So that's a really good sprint. I should tell you there is a deliberate error in that account of double entry bookkeeping. So your homework is to spot it and let me know in the comments. Thanks all. It's really time for coffee.